Thanks, Kyle.
Yeah.
Yeah.
Yeah, no worries, no worries.
All right, I think
We good?
said no. Yep.
Okay, and then everybody can hear online. Awesome. So leverage is one of the most important things in investing in real estate. There's not a lot of investments where you can put 1/20th of the value of the asset down, or 1/5 of the asset value down. So buying a residence or buying a what's called a second home, you can buy it as little as 5% down, and buying a rental property, you can buy it as little as 20% down. Now, typically, unless you're getting into margins on stocks, et cetera, typically you're taking all of your cash and just buying the single stock, usually not leveraging yourself. And in general, it's very hard for you to get the same kind of leverage investing in other investment vehicles as you can in real estate, because real estate is backed by a very safe asset. A lot easier to get funding against real estate than other investment opportunities. So I do want to give you an example of the power of leverage. So in general, you're usually putting 20% down on a rental property. So let's say that you bought a property for $500,000 and put $100,000 down. So that's 1/5 of the property value. If the property value goes up by, let's say, 3%, which is usually what I use for any of my models on a forward-looking basis. So I'd like to use 3%, even if the average has been typically higher than that. But if I assume 3% appreciation on $500,000 and the home value has gone up by $15,000, but your return is not 3%, because you've made the $15,000 on your investment of $100,000, because you bought this property with only $100,000 in. Your return on investment is always the return on the capital you put into the project. So you put $100,000 into the deal, and if the value goes up by 15,000 or 3%, then you've actually made 15% in your money, right? Here's a really cool example. Let's talk about a personal residence with 5% down. So who here does not own their personal residence right now?
Does not.
Does not. Yeah. So just a couple of you. Good. I'm going to get you guys really excited, okay? So if you bought that property for $500,000 with 5% down, so you've put $25,000 down, and the home value has gone up by $15,000. What's your return on investment in that situation? I didn't prep you guys. This is a math class. 60%. 60%. You're close. I know you're very close. 60% return on your money. That's really, really good. And all you're doing is buying your own home. Now, it's not just the appreciation, though. There's a few different factors on investing in real estate. And so you're buying for cash flow, which is one of the ways that you make money in real estate. Now, in general, with 20% down, most properties do not cash flow very positively. Usually with 20% down, you're cash flow neutral, or maybe just slightly positive if it's a good cash flow investment. The Nanaimo is going to be a lot better than where I'm from, Vancouver, where it's really, really hard to find properties that cash flow with 20% down. But in general, a good cash flowing property might generate between 1% to 4% return on your capital per year. So you're putting a little bit of money back in your jeans. So that $500,000 property, maybe you put $100,000 down. Maybe you're getting $1,000 a year in positive cash flow, maybe $60 a month, $70 a month, nothing to write home about. So that's nothing super exciting. The appreciation we talked about, if you assume a 3% annual appreciation, and you're making 15% return on your money per year from the appreciation. But here's one people don't think about at all: the mortgage pay down. So if you bought a property and the tenant just covered your mortgage payments for you, and you had no appreciation whatsoever, so assume that the property values never go up, and assume that the tenant is just covering your expenses for you. Any idea what your typical return would be from just having the tenant pay down your mortgage? About 7.5% to 9%. In fact, right now with interest rates even lower than they have been in the past, it's actually higher than 10%, the return on investment from just having the tenant pay your mortgage for you. So in that same example, if you put $100,000 down into that deal, your tenants are paying down about $7,500 to $9,000 per year on your mortgage and paying that down for you. Who here gets 7.5% to 9% every single year consistently in their stock portfolio? Right. You guys online too. I'm looking at you guys too. So usually when I do a presentation, there's usually 1 in 50 people that put up their hand. There's not 50 people here, so 0 people put up their hand. But it's an interesting observation. So if you total these up, you're making 24 to 27% return on your investment by investing in real estate. That is really, really good, by the way, in case you guys aren't excited already. So this is why I invest in real estate. This is how the return on investment is broken down. So you can see not a lot of your return is actually coming from the cash flow itself. If you're only getting 1 to 4% of the total 24, 27% returns coming from cash flow, not a lot of it is coming from the positive cash flow, but a third is coming from the mortgage pay down, and 58% is coming from the appreciation, which is crazy. Now, that does not mean that cash flow is not important. Cash flow is very important, because if you don't have positive cash flow and you have to keep putting money into the property, guess what? You probably won't be able to hang on to it long enough to see the appreciation, right? So it's still really important to have something that at least covers your expenses for you, so you can withhold any dips and valleys, because the way the real estate market often works is flat, 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 and then spike. And then the values go up by 20% year over year. They don't typically just trickle up at a rate of 3% annually per year. It usually has its ups and downs, and you have to hold on to it for the long term to be able to recognize those gains. So who's involved, or who wants to get involved in real estate? I'm sure a lot of you guys are very interested in investing in real estate, or already are investing in real estate. This information should definitely get you excited if you're not already excited, but it's not that easy, is it? Oh, great, the returns are awesome. I'm gonna go and do this. It's a little bit harder than that. And so, you know, one of the big challenges, of course, is what I get to do for a living, which is looks something like this. Getting a mortgage is not a lot of fun. Who here has obtained a mortgage in the last 24 months? Poor you guys. Not awesome. I mean, this is really what it looks like nowadays. I mean, the number of staff that I have has significantly increased over the number of years. I look back at files that we started, 10, 12 years ago, and a lot of the little minor things like the property taxes, it would just say $4,000 in there. Like, I never needed to verify that information back in the day when I started in this business. And now we need to verify everything. And it seems like anytime a rule comes out, just like government, they come up with a new tax, like as soon as we're out of the deficit, we'll remove the GST and the PST, right? Guess what happens? It never gets removed. Same thing with mortgage guidelines. They come up with a new mortgage guideline, like one that came out recently because of COVID, was, we need to see 3 months of bank statements to verify that your tenants are paying their rents. Okay, well, COVID's kind of gone now, not quite, but it's kind of gone now. And guess what? They have not removed that requirement. So we got to dig into clients' bank accounts, and guess what? Oh yeah, well, the tenant actually, they actually did a small little renovation for $200, so I reduced the rent that month, and it's always a big pain in the butt to actually be able to cross-reference all these things. But the amount of paperwork continually increases, and so it makes our lives a lot more difficult, of course. So let's talk about planning and how you get around the challenges with getting financing and how you build a real estate portfolio. And step number one always is figure out where your money is going to come from. So access to the capital. For those of you that already have a residence, this is what you should have on your residence. You should have a HELOC, or mortgage that has a HELOC or home equity line of credit connected to it. And here's how it works. If you have a $225,000 mortgage on a place worth, let's say, $500,000, you can have access to 80% of the value of the property in total credit, which means that if you had a property with 500 grand, you would have a total credit of $400,000. And if you only need a mortgage of 225, then you would start off with a line of credit, which is on the right, of 175,000. Now, the cool thing is that as you pay down the mortgage, money becomes available on the line of credit. And so you'll always have $400,000 in total credit available. So if you pay down the mortgage from 225 to, let's say, 100, now the line of credit is 300. So you always have a total of $400,000 in credit available. Now, the cool thing about this too is that then what you do is you take the money off of the line of credit, and that is your down payment on a rental property. So now what's happening is you don't even have to get into a situation you figure out, should I save up and buy another rental property, or should I pay down my personal mortgage? Which one do you choose? Actually, having this product allows you to do both at the same time. Now, number one, of course, having access to the credit, super key. A lot of you that have owned real estate for the past number of years have seen the value increase significantly. So you have a lot of cash available in your property. And not a lot of people realize they don't actually have to have cash to invest in real estate. And in fact, from a tax perspective, this is actually the recommended version. And the reason for that is that this portion here, your personal mortgage, is not tax deductible. Any money you borrow for personal use is not tax deductible. Any money you borrow to invest is tax deductible. So the interest portion of the payments on the money that you're borrowing to invest is tax deductible. So now the mortgage that you get on the rental property is tax deductible, and the money that you borrow against your residence to invest for that down payment is also tax deductible. Yes.
When you borrow money like that against yourself, obviously that's going to increase your debt service ratio.
Yeah.
So how do you circumnavigate that?
Yeah, so really what you should do is a couple of different things. Number one, if you're paying down this mortgage, then ideally every 5 years or so, you could re-amortize that personal non-tax deductible mortgage over a 30-year amortization again, which then lowers the payments. In addition to that, making sure that you have 30-year amortization on all of your mortgages, making sure you don't have any personal debts as well is very key. So to give you an idea here, the qualifying payment for every $100,000 you borrow, and this is using what's called the stress test, is about $550 a month. If you have a car payment that is $550 a month, and maybe you owe 25 grand on that car, that's the same as borrowing 100 grand on a mortgage. So what people often do is when they first get set up, is they take this product, they roll all of their personal debts into the mortgage to lower all of those payments. And then they've improved their debt servicing enough where then now they can borrow the money on the line of credit to invest in something else. So yes, of course, if you're borrowing all of the money, that hurts. But at the same time too, if you have cash, you could set yourself up by taking your cash, paying down your mortgage, and then re-borrowing it back out on the line of credit. Well, guess what? You still owe the same amount of money, except now you have a tax deduction on that down payment that you borrowed. So that's and it's a very simple key, but an easy example is I had a client who had a ICBC settlement. We did exactly that. We took her I think it was about $200,000 in her ICBC settlement. We restructured her mortgage so she had a re-advanceable product, paid down her non-tax deductible portion by 200 grand, borrowed 200 grand back out on the other side, and now she gets to write off the interest on $200,000. Back then, the interest costs, interest rates were about 3%. So 3% on 200 grand is about 6 grand a year in interest savings or interest write-off. And her tax bracket was about 30%. And so she's saving about $1,800 a year in taxes by just doing a very simple maneuver. And to be frank, a lot of the time, people go to their bank or a broker that doesn't specialize in working on this type of stuff. And people are often order takers. They say, oh, you're going to use your cash for down payment. Okay, process to go use your approval. But what you really need in addition to that is you need some tax planning. You need somebody to actually tell you, hey, by the way, did you think about this? Or did you think about that? The taxes is a really super important part of this. So now you re-borrowed that money out to invest. There's a really good book by Robinson Smith, who actually lives on the island. I think he's located in Victoria. There was the original book called The Smith Maneuver, written by his father, and Robinson Smith wrote the subsequent revised version where he goes into a bit more detail. For those of you that can't fall asleep at night, great book to read. But actually, it's very, very, very useful information. I hope Robinson is watching this, by the way. But your book's great, Robinson. I love it. So now that you have access to capital, now it's a bit easier to plan and start to look at, okay, what is my plan? How am I going to build my real estate portfolio? It's really important you sit down with somebody that understands how to build this. It is very difficult to get the financing. But the plan is super, super key. You guys may have heard this phrase before, but if you plan or if you fail to plan, you plan to fail, right? Because I've heard that one before, I'm sure. So it's really important to sit down and actually create a game plan. Sometimes we see clients just jumping in head first and just biting at the first deal that they see, and it's really important to understand, where do you want to take this? Do you want to buy 5 properties? Do you want to buy 10 properties? Do you want to buy 1 property? The plan for each of those is very, very different. And as we'll go into later on in the presentation, whether you're incorporating or not, which lenders to use for the first property. If you plan on buying a lot of properties, you have to be a lot pickier with how you set things up right from the beginning, or else it becomes very challenging for you to continue to build it. And access to capital and being able to qualify for mortgages as you build the portfolio becomes more and more challenging, as I'll get into in a little bit. So how do you qualify? This is a really, really important understanding. There are 3 basic methods that lenders typically use. This is the most common method, by the way. Most banks use this method or something similar to this. So what they do is they call it 50% add to income. And in fact, a lot of them just call it add to income. Sometimes they use 80% or 50%, but either way, they're taking this percentage of the rent and then adding it to your income. So let's say that you have a property that generates $1,000 a month in rental income. They'll take 50% of it, and then they add this income to your income. Well, guess what? They only like to use 44% or 40% of your income to use to service debts. So they take $1,000 a month in rent, 50% of that, so $500 is what they're going to use. They're going to add that $500 to your income, and they only want to use about 40% of your income. So they're using $200 of the $1,000 a month in rent. Do you think that's very fair? No. And it's very difficult to build a real estate portfolio if they're only using 20% of the rental income in this example. So some lenders, particularly credit unions, will have an offset. And so the offset is a bit different. In the same example of $1,000 a month in rent, they take 80% of it, so $800, and they would offset all the expenses against that $800 first. And if there's surplus income, they'd add it to your income. If there's a deficit, then they add it in as a liability. Now, in theory, if the expenses on this property are only $800 a month or less, then there's no net effect on your debt servicing for owning this property. With the add to income method, because you're adding something to the income and the liability side, there's always a net impact on your debt servicing. And again, I'm sorry, I know that Jason probably didn't prep you guys for this being a math class, but that's just how the math works. You're just gonna have to trust me on it. The offset is much better, okay? The other version or method here is what's called DCR, stands for debt coverage ratio. This is actually a bit of a hybrid between residential lending and commercial lending. So in commercial lending, and I'll get into this later, this is actually a method that banks use. And it's a primary method that banks use to determine how much you qualify for. So when you have a certain number of properties, some lenders switch to a debt coverage ratio. They like to see that the properties themselves are generating a surplus of income of about 1.1 or 1.2 times all of the expenses. Now, one of the challenges is when the stress test came out, and now the lenders are using a rate of 5.25% to qualify you. The big issue that we're facing right now is that right now, 20% down, you're lucky to find a property that covers itself. But the lender wants you to have a property that covers itself by 0.1 or 0.2. So an extra 10 or 20% on top of the expenses should be going in your pocket. On top of that, they also want to make sure that you're qualifying the payments as if your interest rate was 5.25%, which is double or even triple, depending on which rate you're taking, fixed or variable, double or triple the actual interest rate today. So the problem is it's very difficult with lenders that use a DCR or debt coverage ratio to give you 80% leverage. A lot of time it's 60, 65%. And so in general, the lenders that are going to switch to this method, when you have 2 or 3 rentals, your leverage that you can get through those banks starts to decrease. It gets harder and harder to build a portfolio with high leverage. So in general, we find that these lenders are not great for when you have 3 rental properties plus, because you're going to be putting a larger down payment down to qualify for them. Example, I had a client earlier this year. He has 13 residential properties. His net income per year on his personal tax returns is about $1.4 to $1.5 million. And he has a net worth of probably $8 or $9 million. He's buying 2 condos in Surrey worth about $500,000, and only one of the major banks would finance him because he has too many properties. And yeah, it gets better. And on top of that, they would only finance 30% of the property value because that's all of the debt coverage ratio would support. So 30%, so you need to put 70% down in order to qualify with the bank. So needless to say, that wasn't a great option. And no exceptions, by the way, because it's got too many properties, right? Apparently, they just don't really care to have a strong client in their portfolio. So now that we figured out where our money's going to come from, we have a bit of a plan. Now it's time to start analyzing deals. And I remember when I first started in the business and started working with investors, I would ask people, so how do you analyze a deal? And a lot would say, well, it seems like a good deal, I'd buy it. Oh, really? Okay. That drove me nuts because as a math person, I'm like, no, you have to analyze the deal. You have to look at it. You've got to run numbers. You've got to see if it's a good deal or not. How do you know if property A or property B is better than the other? And so one of the things that I actually did for my very first joint venture that I bought in 2010 was I created a spreadsheet for myself to run deals, and I ended up eventually making the spreadsheet look a little prettier than your standard spreadsheet, and then started giving it away to people at events like this. But having something to run numbers to be able to compare property A to property B, whether it's my spreadsheet or some other tool, there's tons of tools out there. You should have something that allows you to easily run numbers and just modify little minor things and stress test your deal. Sometimes if you're not sure what the cash flow would be, well, what happens if the cash flow drops a little bit? How does that affect your return on investment? There are a couple of shortcuts though. One of the shortcuts that I look at is the rent to price ratio. It's a really quick formula and calculation. So all I'm doing is I'm taking the monthly rent and I divide it by the purchase price. In general, my target is about 0.4% or higher. So if I buy a property or I'm looking at a property for $500,000, then I want the rent to be at least $2,000 a month. So if I take 2,000 and divide it by 500,000, that's 0.4. So I'm always trying to figure out what the rent to price ratio is. That's my really quick and dirty math to see if I'm in the range where I might be able to produce positive cash flow or at least break even on a property.
It's Vancouver prices, so right?
Well,
500,000 and $2,000 here might be good now, but
Do you
It-
also
yeah.
factor in things like, if you're looking, like what you just said, that example is 500,000. If you think you have to put $50,000 into the house to fix it, you factor, so you call that house 550,000?
Yeah. I would, yeah, the total cost, yeah, to get it to that point. And that's another thing too that you can sometimes do. So if you have a spreadsheet, you can also look at it and say, okay, if I buy it for 500 grand and I just keep the tenant in there paying me 1,800, let's say, this is what my return on investment is. What if I put in an extra 50 grand to renovate it and I can get 2,200 on it? Now, is it a better or worse investment? So you can actually run the numbers and see if your return on investment is better or worse by putting more cash into the deal too, which is super helpful. Another key piece of information that I always remember or keep in the back of my mind is that every 100 grand I borrow is about $400 a month, which also means that every 10 grand I borrow is $40 a month. So if I'm in the middle of negotiation and the seller wants an extra 10 grand out of me, I know that really quickly, okay, it's going to cost me an extra $40 a month. Can the cash flow handle that or not? And that's an important thing that to just keep in mind, because at the end of the day, it's all about creating a filter system. If you do a full-on analysis that you spend an hour on, and every property that comes across your desk is going to take you forever to skim through everything to find the ones that are actually going to work for you. And so you're always just looking at shortcuts. So the first shortcut is, what's the rent to price ratio? Okay, boom, yeah, it's in the range. Okay, next, use my spreadsheet. Okay, yeah, next, then I start focusing on the specific building that the property might be in, or the specific area, or some of the redevelopment potential, things like that. Using tools, very important. One of the things that I found to be very useful is determining what the rent is. So I found a website called rentometer.com. Super simple. You put in the address and a rent number and the number of bedrooms and bathrooms, and it gives you some macro data on the rental properties in the area. So it'll give me an idea of what a 1-bedroom rents for, 2 bedrooms. It'll give me the median, 25th, 50th, 75th percentile as well. So if I buy a brand new unit, then I'm probably putting myself in the 75th percentile. If I'm buying a dive and I don't plan on renovating it, then I'm putting myself in the 25th percentile, right? So it gives me a really rough idea or a range of what I expect the rents to be, because I find the Craigslist method to be quite arduous and tedious. You're going through it, you're like, no, I don't know, is this one better than mine? It's kind of hard. These pictures kind of suck. You know, it takes you a long time, and then you're spending a lot of time per property. And again, you're just trying to do these really quickly and speed through them. But if you wanted to dive deeper, then Craigslist, of course, is a good tool. Part of it too, in getting your mortgage financing, is often when you get the appraisal, which lenders almost always require on a rental property, they also ask for what's called the economic rent. And so that's what the appraiser thinks the market rent of the property would be. And then you can also factor that into your analysis too. Now, a lot of the time the bank won't release the information to you and release the report to you, but they may tell you what the value came back at, and they may tell you what the rents came back at as well. So at least you have that information. So quickly filtering things, and ultimately at the end of the day, we talked earlier about how you make money in 3 ways investing in real estate. There's the cash flow, mortgage pay down, and the appreciation. They all drill down to one singular figure and number, and that's the ROI, the return on investment. That's the one that you want to focus in on, because that allows you to compare property A to property B. So if in Nanaimo, I think that the appreciation will outpace, let's say Edmonton, for instance, maybe Edmonton, the prices are cheaper and the rent as a function of the purchase prices is better, then I might say, well, if you just use the same, if you're just looking at strictly cash flow, then you might say, well, Edmonton seems like a better buy. But if I factor in what I think the appreciation rate and how I think that Nanaimo would have a stronger appreciation rate than Edmonton, then all of a sudden you see, well, okay, the cash flow is 2% better in Edmonton than it is here, but just 1% of extra appreciation is 5% return on my capital from the appreciation figure. Well, actually, it seems like overall, the return on investment in total from buying a place here in Nanaimo would be better than Edmonton. And so looking at these and being able to tweak numbers and make it really simple and easy for you to do calculations, I find is really, really valuable, and especially being able to do them on the fly. The other thing that's important too is just gaining a really good understanding of any market. And so depending on where you're going, you want to start to dive into it. And sometimes you'll find trends in certain markets. You'll find that certain types of properties perform better or cash flow better in certain markets than other types in other areas. A general rule of thumb is the more units you can jam into one parcel of land, usually the more income you're going to generate from that property. And so you'll find that in most areas, duplexes, fourplexes, et cetera, will generate more rental income. But there are some exceptions to that. Sometimes, like I have a client that owns a high-end house in Lions Bay. He rents it out to movie directors, et cetera. And all of a sudden, his $3.5 million home is generating $30,000 to $35,000 per month in income, which is insane. And so actually in that particular market, the super high-end works. And you're going to find that in certain markets like Vancouver, fully furnished rentals attracting the directors and movie stars, et cetera, can actually generate better cash flow than a smaller, duplex or fourplex or something along those lines. So different markets will have different opportunities available. And this is just a quick snapshot of what my spreadsheet looks like. But again, there's lots of different spreadsheets and tools out there for you to do analysis on. So another thing is obviously getting connected. It's great that you guys are at an event like this. There's lots of opportunities to connect together, collaborate, discuss what's working for you, what's not working for you, what you're finding. The reality is none of you here are competitors with each other. It's always important to collaborate and share ideas with each other. I find that I find that the more people get into a room like this and chat with each other, they'll find opportunities where, oh, geez, I didn't realize that was an opportunity, or oh, that's a good area. I've never really considered that, and you learn a lot. The number of things that I've learned by sitting in rooms just like this and watching another speaker present, and all of a sudden, click. There's a little moment, an aha moment where you realize, oh my gosh, I've never really thought about something in that particular manner. So getting connected and coming into groups like this is super key, especially as we'll talk about later. It gets harder and harder to do deals on your own. You start running out of cash, you start running out of credit, and eventually you need to find people where you can do deals together with, whether they're out there finding deals for you and you're doing joint ventures with them, or whether you're the cash partner investing in them because they actually have the credit. Same stuff working. There we go. All right. What the heck? Okay. It was working, no problem. So step 5, take action. Nothing's going to happen if you sit around, watch your tail wag around. It's not quite a full presentation without at least one caffeine in it, so I apologize in advance. But taking action is super important, guys. You can sit here all you want, and analysis paralysis is a thing. Trust me. Sometimes I have a client who's like, "Oh, what do you think about this deal?" It's like, Joe, it's been 3 years. You haven't bought a thing. If you just bought any of the deals you brought to me, you would have been a millionaire by now. Just do something. Do something, right? And so ultimately, at the end of the day, the people that are successful, sometimes I see some of my clients, I'm like, I can't believe you're successful. You are just Wild West. You're doing this, you're doing that. You're moving and shaking. And when you're moving and shaking, man, the world feels it. And yet, even though they've made a lot of mistakes along the way, they're still doing things and they're still getting ahead. So the taking action part is a really important key to this. You can do all the planning, you can do all the analysis all you want, but until you start writing offers and just getting your hands dirty, nothing happens. The information is useless unless you actually take action on it. So building, and this is primarily information to just get you started and build those first few properties. And there's a couple of quick tips that I'll go over here. The debt servicing. So when lenders are looking at qualifications, it's almost all about debt servicing. They don't really care about how much equity you have in your home. They don't really care about any of these other factors. It's how much income do you have and what are your liabilities. That's the primary driver. Even these net worth programs, what they do is they'll say, what can your debt servicing cover? And then we're going to add the net worth into it to help you bump up that number above and beyond that. So even with these situations where you might have $1 million in net worth and you're trying to get a mortgage based off of your net worth, they're still looking at how much your income can qualify first and then using the net worth to top it up. So it's really important that you understand that that's the fundamental thing that lenders are looking for on the residential side. It's all about debt servicing. So given that, 30-year amortization on all of your debt, including your residence. Now, some of you are thinking, well, 30 years, that's a long time. Yes, but most lenders allow you to prepay your mortgage by between 15 to 20% per year with no penalties. And so on your residence, even if you don't want to pay it off over 30 years, if you have a 30-year amortization on paper, that gives you a low minimum monthly payment that you need to service, which means you can now qualify for more money. The number of times that we have to restructure clients' portfolios in order to get them qualified for one extra rental property, it happens a lot. A lot of time we start to scroll through it, and when my staff bring a file to me and say, hey, Kyle, this file is not working, I'm not sure. First thing I do we have any debts that need to be paid out? Second thing I look at, is there anything we can do to tweak the income and squeeze a bit more out of it? Maybe if they're self-employed, maybe there's a special program for that. The third thing we start to dive into is, what are the monthly payments on all of these clients' existing mortgages? And earlier I was saying every $100,000 should be about $400 a month. Sometimes we see clients where they're accelerating the amortization on their residence and like, I'm doing the right thing. I'm paying off my house really fast. Yes, but now the bank looks at that and says, well, you have an obligation to pay it off fast now because you've set your payments at that rate. And so now you don't have any debt servicing room to buy a rental property. So you need to re-amortize it, stretch it out over 30 years. And guess what you can do? You can make lump sums on that mortgage. If the lender allows you to pay off 15 to 20% of the mortgage balance per year, you can pay off the mortgage in between 5 to 7 years. Most people aren't paying off their mortgage in 5 to 7 years. You can use the lump sums to do that, and it doesn't affect your debt servicing. So that's one of the simplest keys that we find is just have it on a 30-year, and then feel free to use the lump sum to pay it off faster.
Yeah. Can I forward a question?
Yes.
So from Christoph, I have all my mortgages with RBC, but I'm bumping up against both portfolio loan to value ratio limits and overall portfolio exposure. It's getting tough to get 80% mortgage on the next investment property. Besides a larger down payment, which I don't want to do, and if I can't get my properties revalued to increase the value on paper, do I have any options with non-big bank lenders for additional properties? Who can I approach for a solution?
Yes, well, of course. I know a guy. So Christoph, thanks for your question. So I'll repeat it very quickly, but Christoph has a number of properties with RBC and is finding that he's starting to get a little tapped out, maxed out on the loan to value ratio, but also a challenge with the number of properties and the total aggregate debt with the bank. Actually, shortly in my presentation, I'm going to talk a little bit about the challenges that people reach when they have 5+ properties. I'm going to address this directly. However, not all lenders have these limits. And in general, a lot of lenders have a limit of 5 mortgages with them. And sometimes it's 5 in total. But a lot of them are saying it's 5 with me as the bank, but you can have up to 10 in total. So as long as you have more than 10 and you have more than 5 with that one bank, then you can get financing. So just because your bank says no, doesn't mean that another lender won't say no. In fact, lending guidelines vastly differ depending on the lender. And what we find is very interesting. For instance, Coast Capital has had some of the best underwriting and the best qualifications for rental properties for the last probably 12 to 18 months now. And guess what happened? they're running out of money. Because every lender has a bucket or pool of funds and they say, well, I have this much money that I can allocate to rental property mortgages this year or this quarter. So all of a sudden, Coast Capital started saying, oh my gosh, we're running out of money for this bucket of funds. So now all of a sudden they say, oh, now we're only going to finance our members. And so we're only going to finance you if you're already a member. So guess what we do? We tell the clients, okay, there's nobody that works for Coast Capital here, by the way. So I say, okay, go set up an account, stick 10 grand into a GIC with Coast Capital, and then we're gonna hit the button on it 7 or 8 days. Let's not send it in one day after, but 7 or 8 days later. And now you're a member with the bank, and now you've shown an interest in developing a relationship with the bank. There's almost always a way. But the reality is it does get tougher to build it. I will get into some more details about having, cracking through that barrier 5+. So stay tuned. The car loan example I used earlier as well. If you have a $25,000 car loan and a $550 payment, that's lowering your debt servicing by 100 grand. So a lot of the time, restructuring debt to pay off car loans and other debts is one of the key fundamentals there too. Getting a HELOC should be step number 1. It can be, see, when you get the HELOC set up, the lender is assuming that you're going to borrow all of the credit. And so you have to qualify for the entire limit when you get it. Now, once you have it, not every lender assumes that you're still going to borrow all of it. A lot of lenders on your subsequent rental purchase or acquisition or whatnot, they look at what you actually owe in your mortgage and then what the balance on the line of credit is. Now, a lot of them still use the limit, but enough of them still look at just the balance. And so what happens is when you get the line of credit set up, you need to qualify for the entire amount. If you buy a bunch of rentals, and in general, every rental you own is a net negative, not a net positive. And then later, once you tap out, you go back and say, oh, I'd like to increase my HELOC. Well, I'm just gonna say, well, geez, now you got 8 rental properties. You don't have any debt servicing room to do that. If you did it earlier on and get access to the credit first, then you can go out and build the real estate portfolio. So in general, getting access to the credit before you need it. I will say this, always get money when you don't need it, because when you do need it, they're not there for you. It always happens. It always happens. It's always important to get credit before you need it. And follow the game plan. I talked about this earlier, but if you fail to plan, you plan to fail. So,
Sorry, Kyle, can you just explain the car loan for 25,000, paying 550 a month? Why is that the same as borrowing 100,000 for mortgage?
so 100 grand on the stress test. So using a rate of 5.25%. The payment is about $550 a month on a mortgage. Yeah, so that's the key, is a mortgage, because it's a low interest rate and it's amortized over 30 years, it will be the lowest payment out of any debt you can obtain. And so generally speaking, rolling all of your debt into the mortgage will result in a lower payment,
Or
which,
is it HELOC?
yeah, or a HELOC, yeah. Either one will result in a lower payment because it's secured debt. And the same goes for an unsecured line of credit, for instance. The lenders, or a credit card, lenders use 3% of the outstanding balance. And so if you have 20 grand owing on a credit card, they use 3% of that, which is $600 a month. The 20 grand on the credit card is eating up more than 100 grand of mortgage borrowing power. And so we almost always are consistently rolling debt into somebody's mortgage in order to pay it off. And that's why we do a lot of debt consolidation. Yeah, even for our investor clients, even very strong clients eventually have to get rid of those car loans. So one of the challenges, of course, is hitting the wall. I don't know if I skipped slides there. Yeah, I just skipped one slide. So it's not easy, and it's important that once you hit the wall, almost everybody will hit the wall. It's very, even the client I gave you an example of earlier, who makes $1.5 million a year and has a really high net worth, he's hitting the wall. If he's hitting the wall, you're all going to hit the wall, right? It's going to happen at some point. So the matter of figuring out how to break through that, and there are lots of different ways. And so I want to talk a little bit about planning for properties number 5 to 10 as well. And I'm not sure how many of you are thinking that you want to get there, but I do want to just paint a picture for what that looks like, because it is very different and the challenges are different. And again, it's important to have a plan in place at first, because a plan for buying 1 or 2 rental properties is not the same as a plan for buying 10 rental properties. It is very different. If you plan on buying 10 rental properties, the advice that I'm going to give to a client is, okay, you really need to structure your portfolio properly and I need you to use these specific lenders for these reasons. And it's going to perhaps cost you more in interest because you're not shopping the 40 different lenders in the marketplace. You're shopping just a couple for specific reasons. And so interest rate becomes less relevant and access to capital becomes more relevant. Because think about it this way, right? If you could save 0.1 or 0.2% on that $400,000 mortgage, you might be saving yourself $400 or $800 a year. But if you could buy an investment property and if you're making 24 to 27% return on that $100,000 investment, you're making $24,000 to $27,000 per year by being able to buy into the property, right? It makes sense to be able to continually buy real estate and build that portfolio, and interest rates become less relevant as you grow. Access to capital becomes more relevant. We always find that this is the trend. Somebody's buying their first rental property. What's the rate? Like, you should be asking me how much money you can get. That's the question you want to be asking. So here are some challenges that you're going to run into as you build your portfolio. If you have a large portfolio, this is a challenge. Over 5 properties is tough. Not impossible, but it is tough. Professional landlords, by the way, not okay. Don't quit your job if you want mortgages, please. Okay? A lot of people are like, what do you want to do with your life? You're like, I'm going to buy a rental property and then I'm going to quit and I'm going to be a professional and real estate investor. I'm like, great. I hope you know some people that can qualify for mortgages.
I have a question.
Yes.
How do you see Airbnbs as income?
It's an interesting one. I actually bought a 7-unit building in Victoria that my fiance is literally living in right now, renovating. And so I'm coming over here doing this presentation, then driving down to spend a week with her and help her out a little bit. There were what was that?
If it's over.
Yeah. It is very challenging. It is actually quite difficult. There are some ways to get around it. In general, what people are doing is if you're buying a vacation home, it's easier to position it with the lender that it's a second home, and then you're not using any rental income from it to qualify. So that's the easiest way first, is to try to do it that way. Once you own it, then you're going to have a track record on your tax returns of how much income you're generating on the property. So in general, the lender will look at the total gross income on your tax returns and then divide that by 12 to determine what your monthly rents are, and then they'll put that into your application.
So you have to have like a year's worth of taxes in the books to be able to qualify with the Airbnb income.
Correct. So once you already own it, then that's what they'll do. To acquire it, usually it's one of two things, either the second home route or some lenders will use the market rents done by the appraiser. Now that number is almost always way lower than what you're going to achieve as an Airbnb. The problem is that lenders never like to use something that is a projection and is not guaranteed. So I'll give you an example. When you're determining how much income the lender will use for you, it's always either what you've averaged for the last 2 years, so you have a track record, or what your guaranteed salary would be. So it's either what you've already showed history on or what you're currently earning and what is guaranteed. The same thing applies for rental income too. They don't want to forecast what you might make on your Airbnb. They want to see it's either a long-term tenant, or if you're earning income on it, then what have you already been earning on it? It's hard to refinance Airbnbs, by the way, because the lender knows it's an Airbnb, very challenging to get it refinanced.
Even if you've had it rented out monthly for the last 5 years.
Short-term rentals are considered higher risk for the bank because you have people living in it that don't care as much because they don't have to return to it after that weekend. And so the number of times that they get deteriorated from all the in and outs, people partying in them, et cetera, they just don't stay in the same shape, and the income is more cyclical in many cases too. Victoria and Nanaimo probably are decent Airbnb opportunities because the income isn't a huge spike in summer and then it's a dead zone in the winter, or vice versa, where if it's, Whistler's not a great example because they have a lot more summer sports, but a ski town, for instance, that doesn't have a lot of summer sports is the exact opposite. People that can't manage cash flow are going to make a lot of money, spend it during the summer, and then, oh crap, I didn't save enough money for my mortgage payments because now I'm upside down during the winter when there's not enough income coming in. So it presents more risk to the bank. Yeah. Another thing that happens when you start to build a real estate portfolio is the asset requirements start to increase too. A lot of the lenders, it's not a black and white set in stone figure or number, but a general rule of thumb is that about 30 to 50 grand per property is what is usually advised. And so you should have about 30 or 50 grand in TFSAs, RSPs, cash, stocks, bonds, mutual funds, etc., per property. And that's a good kind of rule of thumb. Lenders like to see that. Some lenders, if you have certain thresholds or limits, like TD, for instance, they use that debt coverage ratio. If you have 500 grand or more in eligible assets, then they lower the requirement for that debt coverage ratio. So they'll give you some breaks and make exceptions if you've got a lot of cash. The reason for that is twofold. Number one, it reduces risk. If you have all of a sudden a large number of people, if you have 5 properties, there's a higher chance that a large number of negative things can happen at the same time. So you could have one tenant trash the place and then move out, and now you have to put money into it to re-rent it. You could have another place that's already vacant. You could have a special assessment on one of your condos for 50 grand because it's a leaky condo or something like that. You can have a lot of things happen at the same time, and you can have a lot of cash calls. So the lenders like to see that they can reduce their risk. The other part of the equation, however, is the banks are here to make money. And guess what? If you've got 500 grand in liquid assets, they might be able to double dip. They could perhaps do the mortgage for you and say, oh, by the way, you should, now that you've got the mortgage with us, why don't you move your mutual funds over here and we'll show you how to make more money in the mutual funds. And so that's often a carrot you can start to dangle. And in fact, once you get to a larger portfolio, that's often how we're coaching clients. It's like, you got to save up some money from liquid assets. And then you literally dangle in front of the lender, like, which lender's going to lend me money? Oh yeah, I'll consider moving them over. I tell my clients, like, when they call you, you tell them that you're interested in moving your money to them. Okay. I know you're not, but tell them that you are. Okay. And then that would make sense. Oh yeah, it seems like a great guy. He's gonna, we're gonna have a chat about the moving the investments. And you know what? Maybe you do move them over, but make sure that they're nice and flexible. And then when they say no to you on the next real estate transaction, then you go dangle them in front of somebody else and move them to the next bank, right? It really helps to be able to build a portfolio by having the liquid assets. A low income is a big challenge, and the stress test doesn't help. They're using 5.25 as the interest rate to calculate the mortgage payments right now. Another important note, and a lot of people don't realize this, it's not just the banks that are enforcing this, it's actually the government coming in and telling the banks to enforce their guidelines, saying, hey, we need to make sure that we have prudent lending here in Canada. You need to make sure that you're lending according to your guidelines. And so it actually happened a number of years ago, 2017 and 2018, there were a large number of audits by OSFI, the Office of the Superintendent of Financial Institutions. And they started going in there and they said, hey, banks, you need to make sure that you're lending according to your guidelines. Well, guess what? Pretty much every deal that we do needs some kind of exception. And so it got really difficult to get any mortgages done. And then you found shortly after that, the lenders got really tight, and then they started loosening up, and then they came out with some new programs like net worth programs. All of a sudden became a thing, because what ended up usually happening in the past is banks would just say, oh, we're going to make the exception because the client has $1 million in the bank and can pay this mortgage off 2 times over. But then the government would come in and audit them and say, you didn't lend according to your guidelines. You don't have a guideline that states that if a client has this liquid asset portfolio that you would do this. And so all of a sudden, a year or two after these huge audits, all of a sudden, almost all the banks came up with some kind of net worth program. And what I heard is that they actually had to get it cleared by the government before they could release it, which is kind of interesting. And so the government plays a much larger part than people realize and think. There was an interesting story from, I think it was 2012, where one of the government officials actually asked the CEO of TD how many of their mortgages were non-income qualified. And the CEO said, oh, about 5% of our mortgages. They had an audit. 55% of the mortgages were non-income qualified. So all of a sudden the government was like, we should probably check out this stuff and look into it. Now we'll say this, TD's program used to be really good back in the day. 35% down, no questions asked, basically. If you don't owe taxes and your credit score is good enough, you put 35% down, there's no questions asked. Because from the bank's perspective, with 35% equity, what could really go wrong, right? But as a mortgage broker, if I didn't have to supply all of the regular documents, if I have a client that had a good income and had good credit and everything, if I could tell my client, hey, I don't need your pay stubs or your letter of employment, you've got good credit and you've got 35% down, just give me your notice of assessment and we're good. Of course, you're going to take the path of least resistance. So that was the problem with the program, is that not everybody needed to be approved under the program, but a lot of people did because it was the path of least resistance for brokers and bankers alike, right? Net worth or some self-employed programs can help alleviate these low income challenges. So if you have a low income, there are a lot of programs. If you're self-employed, then what's called stated income exists, where you state your income at a higher amount and then justify it by providing additional documents to back that up and say and show how that's reasonable. And that's for if you're buying your own personal residence, you're self-employed, you can buy with as little as 10% down doing that. In general, stated income typically exists mostly for owner occupied and not for rentals. One other program that came out recently as well, which is the same kind of thing with the net worth programs, is some lenders now have what's called corporate net income programs. So if you have a corporation and you decide not to pull all of your income out from your corporation, then lenders will use a certain percentage of that income that you keep inside of the corporation as if you took it home. And that will bump up your income too. The last thing I wanted to mention about difficulties here building the portfolio is the complexity. On residential lending, the more complex you become, the harder you are to finance. Lenders don't like to do weird, unique things. And guess what investors love to do? Weird, unique things. You guys are always trying to, oh, let's do this joint venture, we're going to bring in this partner, we're going to buy in a company name, hold it trust for this other entity and do this and do that. The more elements you add like that, the harder it is to get financing. Lenders just like really simple, easy cookie cutter deals. And I can say this because as a mortgage broker dealing with, let's say, a first-time home buyer, somebody buying their own residence versus an investor who has 4 rental properties, the amount of paperwork for the investor client and the amount of time it takes to get the deal done is like 4 times longer, is a lot longer. And so the more complexity, the more the lenders look at it and say, huh, do I really want to do this? Holding properties in trust. This was a common method for a while where instead of buying it in the company name, you would hold it and buy it in trust for your company. So you'd say, oh, I'm buying it in my personal name, but it's actually my company that owns it. That was a bit of a loophole for a while, but that is something that is much more challenging to do nowadays too. So these challenges that we have: low personal income, professional landlords, and self-employed borrowers. Those are tougher. Portfolio cash flow. If you buy too many properties that are speculation buys, this can be very difficult. Or if you're buying development plays. So let's say that you want to buy a property where, okay, this house is an older house on a big lot, but it's right next to a multifamily building. And maybe if I could buy up the whole block, that's a great investment opportunity. But the problem is that it becomes very difficult to finance because in general, those older homes on big pieces of land with tear down houses are not renting out for enough to cover the inflated value of what you just paid for that property because of its development potential. So it becomes very difficult for you to build a portfolio because it doesn't have enough income. The number of properties. So in general, lenders either have a 5 max rule or 5 with them. And most of the lenders that say no more than 5 with them, usually it's no more than 10 in total. And so that's all residential lending, by the way. And then the last thing is liquidity. And I mentioned earlier, 30 to 50 grand is a good target. That's a good number for you to put in. Not saying that you absolutely have to have that, but that is in general a good target for you to be aiming for. Have about 30 to 50 grand in liquidity per property. So talked a lot about the problems and the challenges. Let's talk a little bit about the solutions. So how do you break through that wall? I was expecting more laughs, so that's okay, guys. So one of the things that is important is proper lender selection. Which lenders do you use first? So if we have certain lenders that are only good for your first 5, and some lenders that will go up to 10 as long as no more than 5 are with them, which lenders do you want to use first? The lenders that only go up to 5 total, right? Because they're not good for your 6+ anyways. So you probably want to preserve the lenders that can go 6, 7, 8, 9, 10. You want to use them last because they're one of the few lenders that will go up that high. You want to use the lenders that will only go up to 5. And so usually it's a bit of planning to figure out, okay, which lenders are in the mix or not in the mix when you start to grow the portfolio later on, and using the right lenders first to not run into those walls later. Because lenders usually have a maximum number of properties with them, but also an aggregate lending with them too. Sometimes it's just the number, the sheer number of $2 million max with us or $2.5 million or whatever that number is. And at certain points, you reach higher aggregates and then it has to go up to a higher level management. And they don't call these guys the sales guys that want to make the deal done. They call them risk management. So guess what they're looking at? Their risk of lending to you, right? It used to be back in the day when I first started in the business, Like, I've got this $1 million mortgage lender, I really want you to do it. Like, oh yeah, we're gonna get it done. Awesome. I throw that hamburger at the wall and it would stick. Great, the deal gets done. Nowadays, the risk management people are running the show. They're looking at the hamburger I threw at the wall, like, you didn't package that hamburger up really good. So it's really difficult to get financing if you're just jumping into things and not having a solid plan. And really, you have to adapt to what the lenders are doing. We often are taking square pegs and getting the mallet out and trying to say, okay, I'm going to pay off this debt and restructure this mortgage. And I need you to claim this much money in your tax return next year. And then we can fit you into the box and get you to fit. You're not just going to go to the bank and say, hey, you need to finance me and bend your rules to fit my guidelines. Because the bank's going to get audited and the government's going to say, why did you lend money to Joe? You did not fit your guidelines. So one of the things we look at is use lenders that don't do 5+ in the beginning. And you're preserving lenders that can do 5+, and that's keeping as many doors open as possible for you as you grow your portfolio. So this is a basic concept, but it does really help. There's only, I find that most of my business goes to major banks or credit unions, and most credit unions and major banks have this 5-property cap, and there are ways to break through that. We actually developed, I call it software, but it's a really, really good spreadsheet. I'm sure you guys have figured out now that I really like spreadsheets. But I developed a spreadsheet where you put in all of your properties into one field, and then it actually spits out the debt servicing, the TDS, GDS, the DCR. Don't worry, guys, you don't need to remember any of these. But it tells you all the numbers and it quickly highlights which lenders are a fit and which lenders are not a fit without us having to go through. Because actually, what normally happens when you are doing this is we punch all the numbers into our actual system, not the Excel spreadsheet. And if the numbers don't work, then you have to go through and change it. Okay, I'm going to change it to an offset on all of the rental properties. No, it doesn't work. Okay, I'm going to try this other lender. And then, oh, right. They have a different calculation. I have to add this in or subtract that. It takes forever to do our job. And so I spent many weekends developing this awesome spreadsheet. It makes it a lot easier to underwrite it all at a glance to figure out where does this deal fit. So here's a natural progression. We've done our first 5 properties. You usually buy your residence first, then your first rental, and then getting up to 5 rentals. So we're kind of ending up here. Now you're getting into the 5+, and this is where a lot of clients start to make the transition to commercial lending. So what is commercial lending? I've got another graph, another visual for you guys, but I want to give you an idea of the difference between commercial lending and residential lending, and also small business lending, which kind of fits right into the middle. And a lot of people have never heard about small business lending before, but it's one of the things that I've actually found to be very, very beneficial today, because it fills a bit of a gap. So qualifications on commercial, it's based primarily on the property. Small business is a bit of a hybrid. You're going to notice the trend here. Small business is kind of straddling the line and a bit of a hybrid of both. And then residential, it's almost purely based on the borrower. They're not really using a lot of the rental income from the rental properties. They're looking primarily at you as the individual, which can be good or bad. Rates on commercial can be very, very cheap, like 1.79%. That interest rate, the very low rates for commercial, would be for CMHC insured multifamily. So if you're buying 5 units or more and you're going through CMHC, the rates are actually better than they are for residential mortgages. Normally, though, the rates are in the mid to high 3s as of now for commercial lending, so it's higher than residential. Small business is going to be somewhere in between, and then residential, pretty small bandwidth there, about 2 to 2.5% for 5-year fixed. Variables are much cheaper, by the way. Variable rates for residential are like 1.5% or lower. Loan to value, super wide range here with commercial. As I mentioned earlier, if on commercial, the lending amount is based off of the income that the property produces, and I'm going to talk a little bit more about this in a couple of slides. But in commercial, for instance, sometimes you're only going to get qualified for 25% of the asset value because the income just doesn't produce enough cash flow for you to service a lot of debt. And that's something we're seeing, especially in major urban centers like Vancouver. A lot of the deals that come across my desk, it's like, yep, you can get financing on this, about 20% of the value. I was doing some numbers for a client that bought an industrial property about a decade ago. He paid about $1 million for it. Now it's worth $3.5 million. The property will only service a mortgage of $600,000. So the conversation now becomes, well, does it make sense to refinance it and keep it, or does it make sense to sell it and take that capital and then invest that in a bunch of other things, perhaps buy a couple of multifamily buildings somewhere else? Loan to value for small business can be up to 80%, but a lot of the time it's 75. And then in residential, again, up to 80%. Usually for your first few rentals, 80% is quite achievable. When you start getting into 3, 4, 5, and especially 5+, it is harder to get 80% leverage. Lender fees in commercial are anywhere from 0.25% to 1%. Small business is 0 to 0.5% usually, and in residential, typically there's no lender fees. Broker fees, so in commercial, typically the broker is paid a fee, and so usually a broker charges a fee, 1 to 2% of the loan amount, depending on the size. And small business, same thing, they usually don't pay the broker to do those deals. Residential, it's not very common. I will say that our broker is a bit different. Most brokers just operate in the realm of the 40 different lenders that operate in the broker channel. What that means is that we package up deals, send it to a lender, and then they approve it, and then if it funds, then we get paid directly by the lender. We also have connections with every other bank that does not operate in the mortgage broker channel, because especially as an investor client, sometimes the best option is a lender that's outside the broker channel. So we don't want to turn a blind eye to that option. So we do deals with all of the lenders, but in those cases, we'll go to our clients and say, here are your options. Here are some that are inside the broker channel. Here are some that are outside the broker channel, but a fee would apply because we don't get paid by the lender, so our client pays us. So we're a bit unique in that situation. Appraisals and legal fees. This is quite different. Commercial, 5 grand to 15 grand. The most expensive appraisal I've seen was $10,000 for an appraisal, for a commercial appraisal. Inspections can be quite expensive. Environmental studies, a lot of things that can be quite expensive on that. And small business and residential, typically it's quite a bit cheaper. And the company name, commercial lenders are often or almost always a yes. In fact, sometimes they prefer it. Small business, typically also a yes. Residential, it's much more difficult. Not a lot of lenders like to lend to company names on the residential side. And especially if you have a complex structure, it can be very difficult. So how does commercial underwriting work? They use a debt coverage ratio, and it's all about debt servicing. So in general, what they're looking at is if you're buying a rental property, then they're looking at the rental income. They usually prefer the leases. Sometimes they can use market rents over an existing property, and they're looking at the financials and the rent roll of the property existing. Here's one of the problems. A lot of people try to go in and buy a property that is underperforming on the commercial side. And they say, oh, I'm going to buy it and I'm going to turn over the units. I'm going to make them better and improve the income. But the lender is not going to, again, use projected income. They're going to use the current income, the guaranteed income. And so a lot of the time that results in you having to put a significant down payment down because the property is currently underperforming. Another thing you can do, however, on the commercial side is you can also use, kind of like in residential lending, when you get a mortgage, you are personally guaranteeing that mortgage and they're using your income. When commercial lending, you can provide a corporate guarantee. So if you have a company that has cash flows, you can provide that company to provide a corporate guarantee. And then they can point to the cash flows of that corporate guarantee and use that. So if you're buying owner-occupied real estate where you're going to occupy it, then you can get up to 100% leverage for that if your company has enough income to support that debt, which is really cool. So it's really good leverage if you're buying owner-occupied commercial real estate. Some lenders will even allow you to buy a rental property and use a corporate guarantee to help supplement the cash flows too. So there's lots of different ways and a bit more, I want to say creativity, but there's different avenues you can use on the commercial side to get deals done. And I do find that there's a bit more creativity, I guess, on the commercial side than there is in residential. Residential is very black and white, which sometimes is nice because you know exactly what you're getting. Commercial, you've got to submit everything and see what they say. And that's often a gut feeling or a take on how they feel about it. But ultimately, just like residential, it's still based on debt servicing, and they want to see this DCR, this debt coverage ratio. So they want to see that the income is 1.25 times the expenses. So if you find a property where the operating expenses, not including the mortgage, are 50 grand a month or 50 grand, let's say a year, and if the income is 125 grand a year, then that means in order to make sure that the income is 1.25 times the expenses, the mortgage payments can't exceed $50,000 a year. Because the total expenses, in this case, would be 100 grand, and the total income would be 125 grand. So that's a ratio of 1.25 to 1 for income to debt. So they reverse engineer the maximum loan amount based off of this. This is a really important feature because understanding this will help you figure out how much money you can get qualified for in any potential acquisition on the commercial side. So it's not, you don't get pre-approved like you do on the residential, because they're not looking at the individual, they're looking at each property and how it stands on its own. So I noticed that some of you have pens and paper here, and this is a really cool thing. And I know some of you are falling asleep, so I perfectly timed this to wake you guys back up and get you guys super excited about this. This is probably the coolest thing about commercial lending, and this is what the biggest players do. So this triangle here is effectively looking at how commercial real estate is bought and sold. There are three factors. There's net operating income, cap rate, and value. So the net operating income is without a mortgage, what your net operating income is on the property. So all the income minus the expenses. A cap rate is a market-derived rate of if you bought the property with cash, what your cash flow would be at the end of the year. So in a 5% cap rate market, if you bought a property for $1 million, then you would have $50,000 a year in your pocket. And so again, it's buying it with cash. It's not factoring in the mortgage. And then you have the value. And so if you have two of these numbers, you can solve for the third. So if you know what the net operating income is and you know what the cap rate is, then you can reverse engineer what the expected value of the asset would be. If you know what the cap rate and the value is, then you can determine what the net operating income of the property is likely to be. Okay, I'll give you an example here. Let's say that we're buying in a market. What's the cap rate in Nanaimo, would you say, Jason?
Once upon a time, 5%, probably closer to 3.5.
The math is easier with 5, so I'm going to use 5. Okay, so let's assume we buy in a different market with a 5% cap rate. This means that if you're buying in a 5 cap market, people are willing to pay $20 to receive $1 of net operating income per year. Okay, so you're getting, if I pay $20, if I get 5% of my $20 back, that's me getting $1 back per year. So that's what a 5% cap rate market represents. Okay, so if $20 of value put into it gets me $1 of net operating income per year. But here's the part that gets me super excited. You can reverse this as well. You can buy a multifamily building and improve the net operating income by $1, and it improves the value by $20. You guys aren't excited. You guys not at all, right? Yeah. Okay, you're excited. That's good. That's good. Okay, let me paint a picture for you. So there's a really cool example of a company that that I know that goes down to like Phoenix. They go down to other parts of the U.S. and they do this for a living. You have a business that does this. But this is, I mentioned earlier, my an aha moment. I had this aha moment watching one of their presentations 7 years ago or 8 years ago. So what they did is they had a multifamily building under contract. It was 200 units, and they stuck a notice underneath each door asking if the people would pay an extra $50 a month to have a washer and dryer installed in the unit. Because 100 of them were millennials, they said yes. Okay, us millennials, we like our comforts. So millennials, of course, said yes. I would have a washer and dryer installed in my unit. I would pay an extra $50 a month for that. So working out the math. $50 a month per unit on 100 units, you're getting $600 more per unit, that's $60,000 more per year in net operating income. In Phoenix at the time, the cap rate was 6%. So to work out the math here, what you're actually doing is you're taking the net operating income of $60,000, you divide it by 6%. Again, math class. I don't know if Jason warned you, but this is a math class. Divided by the 6% cap rate, the value increased by $1 million just installing washers and dryers in the units. And in 100 units, do you think the washers and dryers cost $1 million? No. Cost about 150 to 200 grand to get them, to purchase them and install them. There's already a closet that had a hookup for washers and dryers to get hooked up into. So it's really, this is a super simple example. Yeah, exactly, right? It's convenient that it already had the hookups and everything, right? But situations like this exist, and it just is tough to find these underperforming assets and improve them. But they do exist. And an easy example of this is, we're talking, and I overheard some people earlier talk about how the government's next year gonna allow us to increase the rents by 1.5%. Woohoo! Awesome, right? So going back to this example, because we've been having some conversations about this, if you found a property where you had tenants that were stuck in there and lived and staying there for a long period of time, and they're paying $500 under market, and if you found that, okay, well, that if I could bring it up to market, that would be an extra $6,000 a year. And in a 5% cap rate environment, if I could just find a way of getting the tenant out and getting a new tenant in there to pay market rents, if I could find a way, then on that unit alone, I would increase the value by $120,000. $120,000. There's something called cash for keys. Have you guys ever heard of cash for keys? Cash for keys, baby. You flash the cash in front of a tenant and say, would you take $5,000 to leave? Like, oh, $5,000. They're already thinking about the new car they're going to buy and everything. And that $5,000 all of a sudden improved the value of your asset by $120,000. Now, this exists in commercial because people are buying these types of assets based off of the income that they produce. It does not work as well on residential real estate because the value is not increased, because it's still, in general, most people are buying residential real estate for personal use, not for the income that it produces. And so in general, you putting $100,000 in renos into a residential property generates usually $100,000 of additional value, maybe 120 if you've done a really good job. But you're not usually getting surplus value of the money that you put into these projects. In commercial, however, you can find these opportunities where you put $100,000 into it and you've improved the value by $400,000. So those opportunities can exist in the commercial world. So this is a really cool thing, and I hope I explained it well because it's a really complex concept. But this is one of the cool things about buying commercial real estate. So looking at getting creative here, obviously buying commercial real estate and whatnot sounds really good, but buying a 12-unit apartment building might be a range for a lot of you, and so figuring out how you grow and get to that next step. I do want to talk about joint ventures. Who here has done a joint venture before? All right, only a couple of people. Yeah, Monopoly, right? If you chip in for Connecticut Ave, I'll chip in. So in general, in a joint venture, there's usually 4 ways that you bring value to a joint venture: the cash partner, the deal manager, the deal finder, and the qualifying partner. And so in general, there's a combination, and every joint venture is different. The number of times that I have people call me and say, hey, Kyle, so I've got this situation, what should be the percentage that everybody should get? And the answer is, it's all up to negotiation, baby. But ultimately, at the end of the day, it usually drills down to these 4 things. And so you can, depending on the deal, if the deal's really, really good, then the deal finder is probably going to be worth a lot more money than the cash partner. If the deal is very weak, then the deal finder is probably not worth as much, maybe a small cut, right? So there's different elements and different values attached to deal finders. I've done a number of joint ventures. I've done 8, I think, 8 joint ventures. And so each of my joint ventures have been done differently. Depends on the strength of the deal, depends on the investor, depends on what I negotiated. My most recent deal that I did in Victoria, I sent it to a friend of mine who sent it to one of his high ups, super, if you think I'm an Excel nerd, this guy is apparently like a real Excel nerd. And he looked at the deal, was like, oh, if somebody does that deal with that person, then they're crazy. And other people are like, oh my God, that deal's so good, where do I sign? And so everybody has a different way of looking at it. You can't get discouraged if somebody says, oh, if somebody does that deal with you, you're crazy. It's like, okay, well, I guess I'll just keep looking then, right? And you keep looking and find somebody where the deal makes sense. It's always just about creating a win-win. And so you're ideally trying to find a situation where between these 4 things, you have, it's like hiring somebody in your business. You don't generally hire somebody that has the same skill set that you do. 2 cash partners that can't qualify for a mortgage aren't really going to help much, right? And so it's a matter of trying to put pieces together that actually fit. And so a successful joint venture usually is a situation where, number 1, get a joint venture agreement done. Please go see a lawyer and get this done. The number of times that I've heard people say, oh, it was my neighbor, I've known him for 20 years and this and that. And guess what? That verbal conversation you had 4 years ago and you thought you had a pretty good understanding of what would happen if things go sour. If you don't have it on paper, it gets pretty tricky and challenging. I've done, I've helped people do joint ventures with family, and it's like even more important that you get this done in paper and discuss it. Because with family, it's even more likely that you're skipping some of these steps, right? And so it's highly recommended that you do a proper joint venture agreement with a lawyer. The qualifying partner must have the down payment. So this is often a challenge. I find this happens a lot where we say, hey, I've got this guy, he's got a good income. He's going to come in and sign the mortgage. And this other person that has the cash must be silent. It's like, well, I can't just say that this borrower over here is going to have a magical 100 grand pop into their account from Joe over here, and the bank's gonna be like, oh, no problem. We don't care about anti-money laundering here in Canada, right? Yeah, that's actually a big problem right now. And the government is definitely breathing down our necks more than ever on anti-money laundering. The explanations and the reasonability tests, they're called now. They look at an application and say, this guy's 28 years old, he's been making 40 grand a year for most of his life, and you're telling me that he's got 150 grand in the bank. Are you sure? And so we're having to explain things quite a bit more, and things get more complicated. So the qualifying partner must also be able to show that they have the down payment. Networking is key. Coming to events like this. Sometimes I have clients say, oh, do you have any joint venture partners for me? Like, well, I know I have some people that need money, and I have some people that need deals. But if I just connect you guys together and you guys don't know each other, it's going to be pretty difficult for you guys to connect and make a deal happen. And so it's a lot easier if, hey, I know this person and this person, and they both go to the same networking event and they've met each other before, then it's a lot easier to say, yeah, actually, I could connect the dots and help you guys out, and you guys know each other. So here you go. Let's see if there's maybe a deal that can happen, right? But knowing people face to face and being able to sit down in front of people is really important, because there's a big high level of trust required to do a joint venture. And I mentioned this earlier, but finding a partner with different strengths doesn't help to have two people that don't have cash and want to do a deal, right? I won't go too long into this because it's a bit complicated, but we'll talk very briefly about incorporating or not, because this question always gets asked, whether I should incorporate or not. And you can buy effectively in a personal name, in a holding company, or in rare cases in an operating company. Buying in an operating company is typically something that's only done or doable on the commercial side. And even then, for liability reasons, it's still generally not recommended that you buy in an operating company name. It's usually recommended that you buy in a holding company name, and your operating company occupies it and rents it from your holding company. Because then if you're making widgets and you get sued because your widget, a small child swallowed the widget, you forgot to say not suitable for children 3 or under, oops. Then you want to make sure that your assets aren't inside of that company. So often you'll see that those assets are separated. Let's talk really quickly about the difference. So in a personal name, it's easiest to get the financing. The tax rate, which is one of the main reasons that you look at this, the tax rate is between 20 to 50% depending on your tax. The average tax rate in a personal name for individuals is about 41% tax. Holding company, it's more difficult to get financing in the holding company, and also the tax rates are higher, which is kind of odd, right? So why are people buying in a holding company? The tax rate for a holding company is about 50.7% tax. And then you have an operating company, and it's almost impossible to get financing in residential lending inside of an operating company name, unless you're doing commercial lending, et cetera. But on the flip side, an operating company is actually taxed at a very low tax rate. The small business tax rate is about 10.5% for an operating company. So here is a common structure here, and one of the main reasons that people do invest and buy in a holding company name is usually if they have an operating company that is generating cash flow. So this is a common tree that we see. You have an individual, and their operating company is effectively earning an income and then flowing the money up to the person, the individual. But what happens is, if you pay yourself from your operating company, then you're paying personal tax on it, right? And so what often happens is, instead, you have your money coming from your operating company. It either flows up to a cash holding co or directly from your operating company, and it moves right over to your real estate holding company. And so what you're doing is you're lending money from your opco to your holdco, and you don't pay personal income tax on it when you do that. So an example, if you had 100 grand in your operating company, you could pay yourself as an individual, and then you pay 40% tax on it. Now you have 60 grand left, and then you go and invest the 60 grand. Or you could take the 100 grand in your operating company, pay 10.5% tax on it, and then lend it to your real estate holdco. And now your real estate holdco has 90 grand to invest. You might be paying more in income tax in the holding company, but as most people like to do, let's just kick that can down the road and pay the tax later, right? So another feature that sometimes happens too is sometimes if you get to scale, you will also set up a real estate consulting and management corporation. There's some restrictions on this where apparently the CRA would like you to have 5 full-time staff, and if you have 5 full-time staff, then automatically they'll allow this. But at certain scales, you can set up an operating company, which then invoices this holding company and moves all of the tax from 50.7% to 10.5%, because this is an active corporation. This is conducting business, right?
Include yourselves as employees?
Yes, you could include yourselves, but you have to exemplify that you're actually doing work.
Yeah,
Right.
if you were actually legitimately.
What helps is you manage your friends' properties and you manage other people's properties,
Yeah.
right? And so if you have a larger portfolio, then you say, hey, let me manage your properties for you. I'll do all the work, because you probably know something about management. As an example, our Airbnb that we bought in Victoria, we set up a property management company, which to start will only manage our own properties, but we're already getting a ton of people like, oh, can you manage our property? And so by doing that and starting to manage other people's properties, if the CRA audits us, it's like, well, we do manage our own, but we have all of these other properties in our portfolio. So is that a problem? Like of course, we're going to manage our own properties through our own company, because that's how we operate our business, right? I still don't know how the CRA would look at us managing our own specific properties that way, but it's a much better story than you just managing your own properties, right? So this is more complex and much more difficult and challenging. The long story short of it is here's a quick pros and cons on whether you should be buying in a company name or not. If you already own an operating company that is generating surplus income, this is probably the #1 reason to consider buying in a company name versus buying in a personal name. It also helps going with large scale. It can sometimes be easier, in fact, to build a real estate portfolio by buying in a company name. And I won't go into a lot of detail, but there's some complex structures that we sometimes go into about that. And estate planning as well. There are ways that you can actually pass on your estate to your children more easily if it's in a corporate structure than if it's in a personal name. The cons. You're filing now, annual filings to the lawyer, a couple $100 a year. You're paying to get your accountant to do financial statements. That's going to be another $1,000+ per year. Harder and more expensive to get financing. And residential lenders don't lend to multi-tiered corporate structures, meaning that if you have a holding company that buys the rental property, that holding company must be owned by individuals. Sometimes what people want to do is they want to say, well, actually, I want my other holding company to own this holding company, which then buys the rental properties. If you have multi-corporations going up the chain, then most residential lenders won't lend to you. Commercial lenders are usually okay with it, but usually residential is quite difficult. So if I've confused you and you're lost, you're like, what do I do? I'm not really sure should incorporate or not. Yeah,
Having different corporations, companies or whatever, like buying 4 rental properties here, having another setup for another 4 or 5.
that is one of the strategies for sure. If you're using lenders, so if you buy properties with one lender and put them all into one corporation, and you use a lender that doesn't report to your credit bureau or often doesn't report to the credit bureau, then in theory, you could go to the next lender, the next corporation, buy 4 more or 5 more with that lender, and then move on to the next one. It's really hard in practice though, because you're doing a few, and then all of a sudden that bank that you have 2 properties with right now in that one co say, oh no, we can't do this deal. They're like, oh crap. Then you got to find another bank, and then do you have the next corp set up and ready to go, and then you have to assign it to the new corp. It's harder in practice, but in theory, yes, that's the plan. And so we do have clients that try to set it up that way. So just looking at I guess it's the same slide. I don't know why that came up after. All right, I was modifying my presentation, adding a couple humor points, and maybe I must have added it after the fact instead. So turning knowledge into action and committing and doing something. We do have a lot of tools that can help you build your real estate portfolio. So I showed you a couple of spreadsheets earlier, but we have a residential spreadsheet to help you analyze residential deals, commercial analysis as well. The commercial spreadsheet actually calculates that debt coverage ratio for you. So you can punch in the numbers and it'll tell you how much financing you get on the property, which is super, super key. We also do a monthly webinar, and we have different topics that we kind of rotate through. This is the spreadsheet I was talking about. And so we're here to help you grow and give you some planning and help you figure out how you can get to the next stage with your investing career. And in addition to that, I also set up a consulting company. It's called Greenwealth. And so some of our clients really want to dive down into more of the nitty-gritty details of how to get their financing structured and also just planning of their portfolio. One of the challenges, and I'll be very transparent, is that as a mortgage broker, we get paid to do mortgages. What ends up happening a lot, though, is you do these presentations and people start asking, oh, how do I build a real estate portfolio? Should I incorporate or not? And we end up often going down a path where people want to also get the advice part of it, but we don't really get paid to do the advice part. But at the same time, too, I didn't want to just turn away clients and say, no, sorry, we don't do that. And so I just set up a real estate investing consulting company to make sure that people still get that and also get that high level advice from myself, too. It's tough as you grow a company and you have 18 staff members. You want to do everything, but you just don't have enough time to do it. And so this is a way of still giving people that one-on-one time with me to give them that advice and input. So there's lots of planning that we go into. We have an onboarding package. We look extensively into where you're right now, where you want to be. We meet with your accountant and yourself to figure out what your income needs to be, especially if you're self-employed. We do a lot of that planning with the accountant and figure out what your income needs to be and setting that up on an annual basis. We also have a program called LenderLink, and that was that spreadsheet that I showed you guys earlier. But with Greenwealth, we have discounted fees. So instead of paying what you would normally pay as a transaction fee within our mortgage company, there's discounts if you're in Greenwealth. So if you're doing a lot of transactions, with some of our clients are doing, then Greenwealth may be a good option for you. So anybody that wants to learn more about that, you can book a consult, and I'm happy to explain more and go into more detail. Otherwise, I have a lot more information on my website and FAQs, downloadable spreadsheets, things like that. Anybody who'd like a copy of my book, this is a good fundamental book. So it's called Rockstar Real Estate Investing. And it's really good for just understanding a lot of the fundamentals that I explained today. And if you or even a family member is interested in a copy, you can email us at info@greenmortgageteam.ca, and we will, and please put your address in there, and then we will mail you a copy. I'm always surprised that people say, yeah, I'll have a copy, please. I'm like, what's your address? And it's like, and then they send their email. I'm like, I can't email you a hard copy of the book. I need your mailing address, please. And yeah, we are located in Vancouver, but we do mortgages effectively across the country, except for Quebec, because Quebec is really weird. They like to do things differently there. So yeah, awesome. I'll open up the floor for any questions. I'm sure there's some questions from people. Do you have any questions in the chat?
Not right now.
Yeah. Yep.
You talked earlier about hitting the wall. Have you found that there's different types of walls to hit? Because we found, you mentioned like the financing part of it. Well, the wall we hit, Jason will tell you about it too, is we looked for properties that made financial sense in the rental and around just the wall.
Yeah.
We couldn't, like in this market, there was nothing that was valued where we could rent it. I don't know if you guys have this problem too, like we find nothing where we could rent it, where we didn't have to pay out of our own pocket.
Yeah.
So for us, that was just no.
Yeah.
So
Yeah.
it's that concrete wall to hit. So like, how do you?
There have been times that have come up where this wall comes up, and in general, the requirements start to change a little bit, where you start to have to look in different markets. Like coming from Vancouver, for instance, we hit that wall a while ago. You know, you can't buy a detached home and have a cash flow anymore, and so the opportunities in Vancouver are very different. For instance, In Vancouver, the cap rate is lower. So that means that if you buy a building with cash, you're going to get less cash flow per year than you would if you bought a building in another market, like Nanaimo, for instance, right? Interestingly, there's an opportunity hidden there because although you're getting less cash flow, if you buy in a market like in Vancouver, and it's probably a little higher than 2% of a cap rate, but I'll use 2% as an example. If I buy in a market where the cap rate is 2%, that means somebody's willing to pay $50 to receive $1 of net operating income. Well, guess what? That means if I improve the net operating income by $1, I can improve the value by $50, not 20, like the example I gave earlier. So there's actually an opportunity kind of hidden in the mess. I will say that residential real estate is shot through the roof, and it is harder to cash flow properties for sure. I do find that in general, you're having to find opportunities where you have more units in the property. And that might mean trying to find something where you find a property and you could easily split off the basement into 2 suites or something like that, right?
Yeah, we looked at that too, and we've made offers that were, substantially above what they were asking.
Yep.
And it turns out it was substantially lower than what they took.
I know.
So it's really, we found it to be quite a big bit of a guessing game to try and value the property, and so
it is definitely tough right now. And if you are trying to buy for cash flow, it is harder. You're getting a higher rate of return from the mortgage pay down. And I don't like to assume this, but there is currently with a low supply market, there's upward pressure on values, which means you're going to make more money on the appreciation part too. But the cash flow is tougher, right? And it's scary that
I'm afraid to depend on just that.
I agree. And a lot of our investors are just kind of waiting on the sidelines. Like usually investors are a larger percentage of my overall, purchasing and buying frenzy, I guess. A lot of investors like, it's not working at these numbers. I'm going to look elsewhere. I'm going to look in a different market, or people are pulling out the money and they're investing in different types of things. What I have found people are doing more frequently is doing more multifamily deals where themselves and a few other people get together and do a bigger deal together.
But bigger deal, you mean like apartment buildings?
Yes. Yeah, that's more common. That's what I'm finding is more frequent. Or buying a very underperforming asset and trying to improve the rents on it. Something that nobody else wants to buy. Because one of the opportunities as an investor is when I smell cat pee, I smell money. Right? When I see, yeah, oh yeah. Mhm, oh, yeah. So things like that, for instance, a regular homeowner walks in like, oh my God, let's leave this place, right? Devalues the asset, you can pick it up for a cheaper price. So distressed assets are an opportunity as an investor too, because those won't have the same buying frenzy. Some of those properties will sit on the market, and eventually the seller like, oh, I guess my dive is not going to get multiple offers on it, right?
So like.
And that being said, right now, that's not the case. People don't care about it.
Hypothetically speaking.
To a certain extent, yes. Yeah.
So being liable for anything. Is there a market that you find more interesting at the moment on the island?
On the island?
Yeah.
Obviously the vacation rental market is very interesting. A lot of my clients are buying vacation rental properties. Yuki and Tofino are quite expensive, they're great markets, but they're very expensive. So it's challenging to make the cash flow work there. For a while, Soup was undervalued, and now I find it's harder to make the numbers work there. But for a while, you could buy properties in Soup for $700 or $750, and the rents were $3,600 a month or $3,700 a month, but that's more difficult now too. Duncan is an area that I'm seeing some development in. Parksville, the cash flow is not great in Parksville, but I think the appreciation in Parksville will be decent. Honestly, what I think will probably be a good buy is condos in major urban centers, and I would call Victoria a major urban center. The units that I picked up in May, or at least that's when I had written my offers, I had them appraised. So It was a 7-unit building and there's 7 strata titled units. It was a private sale, so 5 of the units were from one seller. While I was negotiating with her, I asked her who owned the other 2. She said her ex-boyfriend. I'm like, great. I'm like, can I have his number? And she regrettably gave it to me. And then I called him up and bought his 2 units as well. But we bought those units for let's call it 3.5 million. And we just recently reappraised them and they're worth 200 grand more. I think that major urban centers will have people slowly come back to them. Now, the $450,000 condo renting for $1,500 a month doesn't get me super excited. But again, the appreciation value is there, and the ability to get back into the medium-term fully furnished rental opportunity is there. Because what happened is, in my research, I looked at this website called AirDNA, which gives you macro data of Airbnbs, and it's a good function of what's happening in the marketplace. AirDNA, yeah. You can pay per month for a subscription, and what it does is it gives you all the macro data for Airbnb markets in that area. And yes, demand had decreased when COVID hit, but guess what also happened? Supply also dropped, and supply actually dropped more than the demand did. So the prices actually didn't really drop off a lot for Airbnbs. But demand is very elastic. So once people can travel again, then the demand comes up. But guess what's not very elastic? Supply. Because what a lot of people did is they said, oh, COVID, okay, I'm gonna stick a long-term tenant in my unit. It's so hard to get rid of those long-term tenants, right? Very, very difficult. So now what's gonna happen is all these fully furnished opportunities, not a lot of people have units that are empty and available to have long-term or medium-term or long-term tenants that are fully furnished in there. So if you don't want to Airbnb it, maybe something that's short or medium term. I know I was talking to a company that does employee transfers. A building that we bought in North Van had units that were valued at $700,000 and they rented for $4,300 a month gross. Property management took 30% off the top, and so it's about $3 grand a month net for the owner. And $3 grand a month net on a $700,000 place actually was cash flow neutral for condo in North Van, which was pretty good. That same management company was trying to get a foothold in North Vancouver. We had some conversations with the building that we bought, but because we wanted to do Airbnb and we were going to manage it ourselves, we were almost kind of competing with each other. But they're looking for more medium-term, fully furnished units in Victoria because there will be more demand for that as employees start to travel again.
So how about, speculation tax on the units that you're Airbnb out?
It's a cost of doing business, but when you're getting $200 a night on these units, that's almost $6 grand a month on a unit we paid $440,000 for. There's a management cost to it, but we've scaled because we have 7 units there, and we've hired a part-time property manager that we're training, but she's going to get paid $1,500 a month to manage our 7 units, which it'll be quite profitable for us. The cash flow on the deal is going to be quite good, but we're still in the process of turning over the units. But it is tough to do like a one-off Airbnb for sure, right? And so that might be where instead of doing Airbnb, you do like the medium-term stuff where you just have somebody else take care of all the management for you. Because it is, unless you have enough units, it is a lot of work. I have a unit in Langley that we turned into an Airbnb because it was a pre-sale that we bought, and I didn't really want to sell it. We closed during COVID, the worst time to buy a property. But of course, that's when the pre-sale closed, so you got to close on it. And at the time, there was a problem where if you put a long-term tenant in the unit and you go to sell, there's actually some situations where the buyers show up on closing day and the renter's still like, oh, hey, what's going on? It's like, you were told to leave? Like, oh yeah, but the BC government said that I don't have to leave. Now what? Right? Yeah, exactly.
Yeah.
So in that situation, I was like, well, I don't know if I'm going to need to sell this condo because I have a business that, at the time I had 8 employees or whatever, like I might need the cash. I don't know what this whole COVID thing is going to look like. So we decided, okay, let's Airbnb it. It's a good way of testing it, see if we actually like it, because it is a hospitality business. And if it wasn't for my fiance who really likes to be the detail-oriented person and make everything perfect. For me, I'm like, oh, this tenant needs a freaking pizza cutter. Like, come on. Like, I'm so busy right now. I can't deal with that kind of stuff. So you really have to make sure that you're okay with that. on the Airbnb side, but I do think that maybe the medium term fully furnished rental stuff, because there's a lot of people that have a flood in their house and need to stay somewhere for a short period of time. Like there's people that have employee transfers, and there's a lot of opportunity there where people need to stay somewhere for a few months and they want something nice, and the fully furnished units can rent for a premium. And I do think the supply of that is lower than it has been in the past. And I do think that there will also be good appreciation on it. So I do think Vancouver and Victoria condos is a good opportunity.
Do you factor in the possibility of having a buyer in the future pay GST if they purchase something that's been run as a short-term rental?
No, that's actually a good point. But I believe you just have to remit the GST on the income that you're paying. Is my understanding, but I haven't talked to a lawyer about that aspect. If you didn't pay, if you bought used product and didn't pay GST on it and then rented it out, if it's 30 days or more though, I don't know if I don't think that classifies as short-term rental if it's more than 30 days.
No, I just wonder the condos, if you're running them as short-term rentals, and quite often especially if you're paying the hotel tax and stuff like that, they consider that now a business. And when you go to sell, you're selling a business asset, and the buyer can be responsible for paying GST. And if that's 5% of the purchase price, you've essentially devalued the property by 5% by running it as a short-term rental.
It's an interesting point. So we've looked at our exit strategy on this particular building in Victoria, and there's a couple different angles. Unwinding the whole Airbnb thing, because they are individual strata titled units. We could just slap some paint on them and they're just regular units again, and then sell them that way. However, on the flip side, because we're operating them as Airbnbs, we have a complex corporate structure where the beneficial owner is an operating company, and the current owner, she's a sly girl. So it was a tourism and accommodation business that owns the property. And so we've set it up where we're going to have, it's called Vic Island Tourism and Accommodations. And we're trying to position it as an operating company. And we know that the GST might apply if we do it this way. But also, because it's an operating company now, any income that we pull out of the company would be taxed at the operating company tax rate. And so we might pay more later on down the road. But instead of paying 50% tax on our income we pull out of the company, we're paying 10.5% tax on it. So yeah, there's some pros and cons back and forth, but it is something we looked at a little bit. But I talking to a tax lawyer, they thought that we might be able to still unwind it and slap some paint on it and do it. But yeah.
So putting a medium-term tenant in maybe for half a year, so like on a longer-term rental, and then just saying, okay, it's a rental, I'm selling it this way, you still have to pay the GST.
Well, I again, every accountant will give you a different example, but I just from my experience in real estate as an agent, I know somebody that sold firewood off of their property once upon a time, years back, sold the property to someone else, and the buyer was forced to pay GST because that property was actually a commercial property that was used to sell firewood in the past, and on a $1 million property, that's $50,000. So it did devalue the property by $50,000, right? So again, that's up at CRA, and unfortunately, when you ask somebody if GST is attracted on a property, if it's residential, it's exempt. If it's commercial, it attracts GST. When it's short-term rental, that's still kind of questionable, and nobody can really answer until the CRA basically audits it.
That's one of the problems, honestly, with the short-term rental thing, is that it's still kind of a new thing.
Anything 30 days or longer is not a short-term rental.
Generally, that's how the cities usually look at municipalities. Yeah. So in Vancouver, for instance, no short-term rentals are allowed. You can Airbnb if the building allows it, and if your tenant stays 30 days or longer. That's not considered a short-term stay. That's a medium-term stay. So the reality is the hotels have been lobbying because the Airbnbs are taking away from hotels. Why are hotel rooms staying empty? and you're taking away from rental stock, which means that if you have less supply for renters to use, then now it's increasing the rental rates, right? So that's the concern.
So just so I'm clear, anything 30 days or longer is not considered short-term rental?
And is there a risk of buying in a municipality that currently allows for short-term rentals and then changing the bylaws to, if you're dependent on it to cash flow as a short-term rental and all of a sudden that's not an option? Is that something?
Yeah, for sure.
We're actually talking right now in the time about that.
Oh, yeah.
Yeah, they are, we configuring, I called in just to see if I need a business license, if we possibly open up an Airbnb. And I said, not at the moment, but they're currently talking about it and early next year. I'm supposed to call back because then they have all the ducks in a row, so.
And are they looking at Airbnb and short-term?
Well, Airbnb side, I asked for that, so
Yeah.
I, this short term.
Yeah.
But
Yeah,
it's also the
it's-
city of Nanaimo, which means it'll take them 10 years to make.
Yeah, really.
Nice,
So
yeah.
I say they're gonna do it about 10 years. 14
Yeah.
studies.
It is a tough one for sure. I think the building that we bought, I think there's only 17 or 19 buildings in downtown Victoria that have the zoning and whatnot. And on top of that, it's grandfathered, and we emailed the city to confirm, and they emailed in writing that as long as at least one unit in the building is rented short term, that you're grandfathered. Now, it doesn't mean that they can't absolutely change that, but I do have something in writing that I stuck in my files to make sure that I'm covering my butt as much as possible, right? And I know that when I was raising capital through investors, that was the primary concern, is like, what, Airbnb, it seems like you, based on your numbers, you probably do really well, but like, what if it gets shut down? So why do you have this email? Like, yeah, but what if it still gets shut down? There's always some concern with that, right? Yes.
So if everything over 30 days is not short-term rental anymore, does it fall under the Residential Tenancy Act, where then come to the same problem? If the tenants don't want to leave, then are you?
Yeah, I don't know how
Up to
the,
6 months, that's your medium term.
up to 6
6
months?
months,
Yeah, okay. Yeah, I don't know enough about how the property managers do it. I don't know if this makes a difference. It might or might not. But sometimes the property manager will set up a lease with the owner. And then any tenants that are using it underneath them are subtenants. And that might mean that then any tenancies are having to follow the head lease, the head tenant. So if the property manager says, I'm leasing from the owner, and then anybody that uses it as a sublease underneath me, then it might point to the terms of that sublease. Maybe, I don't know enough about it, I'm just kind of spitballing, because I know that when we bought that building in North Van and there's a few units in there, they all had lease agreements with the property manager. And that might be a way to say, no, you're just subleasing it from me, and we have to abide by the lease agreement that I have with the owner. That could be it.
I have a question back to the holding company and the operating company part.
I thought you're super interested in that. The one person who learns it.
So if you have a holding company, an operating company, and you bought a rental property outside of all of that,
Mhm.
before you had those property or that thing set up, would there be an advantage to selling your existing rental property into that, or can you transfer it, or is there any way that?
So if you move it into the company name, it is considered a deemed disposition, which means capital gains triggers
That's what I was-
and
yeah.
property transfer tax triggers.
Okay,
However, on both of those items, if you talk to a good accountant,
Yeah.
there's something called a section 51C rollover or something like that. I don't remember exactly what it's called. But there are ways where you may be able to roll that asset into the corporately owned company.
okay,
I believe you have to show that it's the same owners of the corp that owns the property individually.
Mhm.
And I think you just kick the can down the road on the
take a
tax.
shot.
I think so. So talk to your accountant about that, because that could.
So what
happen.
about the land transfer tax with that?
What you
Oh,
can
yeah.
do, so what you can do is you can hold it in trust for the holding company from that point onwards. And so then it's treated tax-wise and liability-wise as if it's in the company's name from that point onwards.
Okay,
So that is a way of getting around the transfer tax, and then you just have to make sure that you're not having any capital gains being triggered, and that would be that section 51C rule or whatever it's called.
yeah, okay.
Yeah.
And does that be a good idea, or does it matter if you have any?
Well, I think a longer discussion needs to be just, you know, you have to look at like,
Yeah.
does it make sense for it to be in the company name or not, right?
Yeah, okay,
Yeah, that's a good question for the accountant. Accountant, lawyer, and if you're trying to acquire more assets. then
Well, that's-
broker.
and that's what we have that real estate holding company set up for, is to buy some more real estate, so does it make sense? But we'll get into that with our accountant and some mortgage brokers. and
Yes.
that too.
Exactly. Some worse.
Yeah.
You got 3 different opinions from 3 different people.
Yeah, exactly.
Just like the accountants, right?
Yeah.
Speaking of accounts, do you have, or are you able to provide a list for maybe some guidance on where to find some really good real estate based accountants? Like, you know, the mindset banking where they understand like, or maybe like the write-offs, you know, aspect of things and like, I don't want to say, but like creative accountants, I guess. but in that space.
Yes, you know me. Yeah. Yeah, there are some accountants are better at that than others.
That's right.
A lot of them don't get the real estate stuff. They just don't do it themselves. They don't invest in it. So I actually know a few that are located in Victoria, and they're very good at what they do.
Okay, well done. Sure, thank you.
Any other questions?
I don't have any questions from online.
No. Easy.
I got another.
Yeah.
question, sir. Along the same lines as the accountant, do you know, specifically mortgage brokers or lawyers, for example, that specialize in joint ventures?
To be honest, very few mortgage brokers that specialize in doing joint ventures.
They'll just say, oh, no.
Lawyers there in the lawyer.
Barry McGuire in Edmonton is very good. Richard Letting in Vancouver is very good as well. Most of my clients that do joint ventures use him, and I've used him for all of mine. So he's very familiar with them, knows all the ins and outs. Mortgage brokers, not a lot of mortgage brokers like do that on a frequent basis. I mean, I'm not pumping my own tires, but there's basically like, there's one mortgage broker in the top 25 in Canada that does a lot of investment properties, and he's in Ontario, and then I'm the other guy, and I'm located in Western Canada. A lot of the mortgage brokers that used to focus on working with investors started to dwindle as it got more and more difficult and challenging. And it's kind of weird because as a business model, in general, when people are buying their own home, usually those are more expensive than an investment property. And on top of that, when you're buying your own home and you're just a regular salaried employee or whatever, there's less paperwork. And so it's like counterintuitive that mortgage brokers specialize in working with investors because it's actually more work per transaction for less money per transaction. And the lenders actually don't like it. Some of my lenders like, Kyle, you need to send me some owner occupied deals too. Like you got to balance it out. So I'm always trying to like, oh man, like how do I make sure I hit the quotas with my lenders so I can jam them full of rental property deals? And you know, it helps to send them enough volume. They're like, fine, whatever, I'll do it because we send enough business, but it's tough. But I just don't know. I don't know a lot of them on Vancouver Island. I don't know very many bidders here.
Can you repeat the lawyer of Vancouver for the joint venture?
Richard Ledding, Ledding.
I just wanted to say, so, well, Jason announced that you were coming last month, so I already started working with you guys.
Awesome.
Because I had a mortgage broker that I guess she was an independent, she never called me back.
Oh,
So like I couldn't figure out what I could qualify with, so it was good, I've been working with Michael Brown.
Yep, awesome.
And these guys answered the phone and and today, I think Michael was talking to my accountant.
Yep.
Because he said that my accountant did some stuff that was great on a tax perspective, but because I wanted to refinance multiple properties, it's, you know, wants to know what he should do moving forward, right? So that was great, so to point that out.
Thank you, thank you. Yeah, we're having a lot of conversations with accountants right now. A lot of clients need to figure out what the income needs to be next year, or for the 2021 year, so they can qualify for next year, right? Yeah, definitely part of the planning part of it. And I do have a rather large team so we can handle, phone calls and get back to people. It's been tough. I can only imagine without a larger structure, and team and a system and all of that stuff, it'd be really hard to manage the type of volume that we saw. To give people a perspective, and I noticed this myself. So our company's volumes are up 65% from last year. So you can imagine any business growing 65% over a year. By the end of the year, we'll probably be 2019 plus 2020 combined volumes. I've gone from 8 staff members to, as of 2 weeks from now, I've decided one more person will be at 19 people. And Dominion Lending's overall volumes have increased 60% over the last 12 months. So I'm not an outlier. Everybody's grown substantially. It's been busy. It's been very busy, and it's tough to manage that. And a lot of people are too small, and you don't have time to hire somebody and train them, right? So I finally kind of cracked through that barrier. We're large enough now that if I hire somebody, I don't have to sit there and train them and spend extra time, right? I have staff and we have systems that help make that simpler, but it's been a tough go. Last 20 months have been tough.
Because my other mortgage broker, I gave her a bunch of mortgages as my mom, and then all of a sudden she doesn't call me back. It's not like I did anything offensive, but she's just too, well, maybe I was too complicated, but she, yeah.
That's one of the big challenges is these deals get more and more complicated. And a lot of the time, for me, when I jump into a complicated file, the first thing I usually do is I use my spreadsheet tool because I can put everything in one glance and I can fiddle around with it and it'll tell me the numbers with multiple lenders at the same time. Otherwise, these files, when you get really complicated, most brokers just have a different set of relationships. If you deal with owner-occupied deals over and over again, then your lenders are going to be more rate focused. And when you're dealing with investor clients, you're going to be dealing with more product lenders. So lenders that have more programs where you can qualify the clients, and maybe the rates aren't as relevant or important to me or my clients because it's just getting the credit. Who's going to give me the most money on these deals is more important. So my relationships are generally a bit different than most mortgage brokers would do. Not to say we don't deal with the lenders that are really aggressive on rate, but I don't send them as much business as proportionally as a broker that does mostly owner-occupied stuff. So most of my clients are I deal with a lender called the Korean Exchange Bank in Vancouver. Anybody ever heard of that bank? I hadn't until a couple of years ago either. But all of a sudden I heard that they do 100% rental offsets. I'm like, sign me up, baby. Let's do this. So it's a matter of different lender sets and who does what. Always investigating that. Yeah.
That's good, but Michael might need your help because clients need really complicated.
That's okay.
And they're waiting for something to come back.
Oh, okay, I'm one of the things too. I've set up my structure so that I hover over the business, but I'm not a key cog in the wheel. I've had that before where you try to deal with every single file and you do certain touch points, but then your calendar is booked up literally what used to be 10 to 11 hours a day booked to the 15-minute increment. And when anything would come up, like a fire would come up or whatever, you're like, you can't deal with it, right? And so that also makes me more available when things like that come up. If you ever need me, you just email me and I can jump into it within usually 24 hours. So it helps to have that system or approach where then you can kind of jump into things and whatnot. Usually Michael's pretty good about pulling me into something though if it is complicated. So yeah. Yeah. Any other questions? You guys are ready to rock? Ready to go buy a bunch of real estate? Buy some multifamily buildings?
Yeah.
Yeah. Yeah. Yeah. Right, I like it. Yeah. Cool.
I got one more question, but maybe I'll shut off the Zoom meeting first. So you're not recorded. Thanks everyone for joining.